Look at November 2015, question 4. It's called rigs drilling. November 2015, question 4. It's question 4, part C, in November 2015. So Rigs Drilling Limited is a mining company dealing with petroleum products. Now, during the year ended, the following details were extracted from the company's financial statements. So geological costs, exploratory drilling costs, acquisition costs, lifting costs, lease operating costs, costs of refining crude oil and natural gas revenue, depletion and depreciation, share-based compensation, general and admin expenses, reversal of litigation expenses, finance expenses, decommissioning costs, drilling machines, investment income, impairment losses, intangible drilling costs, professional fees, loan repayment, tractor, derivative oil losses, restructuring expenses, forklift, additional information. Intangible drilling costs include 420,000 for well, which failed to yield crude oil and was abandoned. Restructuring expenses include 582,000 paid to a consultancy firm that restructured the capital structure of the company. Exploratory drilling costs include plant and machinery, erection of rigs and tankage, pipes and storage tanks, factory building. Professional fees include 800,000 for services provided by the general manager of the parent company. Required a statement showing the taxable profit or loss for the year ended 31st December 2014. So for this one, you have to look for incomes. It's different from the other one. The other one, you are preparing a statement of adjusted profit. We had a statement, so you are adjusting. But here we prepare from the information you have. So you prepare a statement of adjusted. It's not actually adjusted. There's no adjustment. It's not. I don't have to worry. If you've noticed, I've consistently put 2021 because this is the year that is relevant to you. You'll never be asked in any exam to use 2014. It will always be 2021. And that is what I try as much as possible to title our statements by, yeah? Because that would be our tax year. So here we look for income, and then we look for allowable expenses. So incomes, we have the main income, which is oil and natural gas revenue. We have oil and natural gas revenue. And oil and natural gas revenue is 98,000. This price would be rather small. But that is not the only income. For example, we also have investment income of 464,000. Investment income is 464,000. Then you have some interesting income there. It's called reversal of litigation expenses. There are going to be litigation expenses, but there's been a reversal of 9680. So reversal of litigation expenses. Of 9680. So this should give me the total income, and I will lessen allowable expenses. Allowable expenses like geological costs. Geological cost is 8468. Exploratory drilling costs as a note number 3. So in note 3, we are told exploratory drilling costs include plant and machinery, erection of rigs and tankage, pipes and storage, and factory. All those will need to claim investment allowances. So we simply deduct them from exploratory drilling costs. So from exploratory drilling cost of 146,400, we subtract the total of the items in note number 3. So that would be 4.8. That would be 1.6. That would be 9480. That would be 400. So from this, we'll subtract 64,280. The capital expenses. The difference of 82 and 20 is what we tried there. So capital expenses will wait until the very end, then claim allowances. Then you have acquisition costs. Acquisition cost amounts to 19,800. Then you have lifting costs. Lifting costs amount to 12,600. Then you have lease operating cost of 64,780. So lease operating costs. Lease operating cost. Cost of refining crude oil is 18,240. Cost of refining crude oil is 18,240. Depletion and depreciation is not allowable. Share-based compensation is capital because you are giving out shares. We can deduct general and administrative expenses of 17,340. So general and admin expenses is 17,340. Finance expenses, that refers to interest on loans. So we have finance expenses of 6,400. That's interest on loans. Finance expenses is 6,400. Then we have an item called decommissioning costs. Now, decommissioning cost is the cost for clearing the site after mining or after oil exploration comes to an end or ceases. Now, since this statement is not for a business that is ceasing, those decommissioning costs must be charged against the particular well that is closing. So it's not relevant here. So those are like, cost of winding up. So winding up should be charged against income generated from that winding up process, not from the main income statement. So we will leave out decommissioning costs unless we were given the particular one. Remember what we said about ring fencing? So income must be matched with the expense where it's coming from. So the examiner probably would have provided the well that is being decommissioned. So you charge there against the income from that well, not in the general income statement. So we leave out decommissioning for now. Then drilling machines, we will claim investment allowances because this is capital expense. Investment income will deal with that. Impairment losses cannot be charged here because those are losses of a capital nature. They are disallowed under section 16 of the Income Tax Act. We are told that intangible drilling costs can be allowed, but we have a note. Look at note 1. It says intangible drilling costs include for 20,000 for a well which failed to yield crude oil. So we'll adjust our intangible drilling cost not to include that well that failed. So intangible drilling costs. So now 3420 minus the well that failed. So we only charge here 3,000. So the cost of the well that failed should be charged against the same well where you specified sources, you match Professional fees is 2,600, but there's a note 4. Professional fees include 800 for services provided by the general manager for the parent company. So professional expenses for the parent should not be charged against the branch. So you say professional fees. So professional fees. You will have 2,600, but you will disallow the 800. You disallow the 800 relating to the parent company, so we charge only 1,800 for professional fees. Then you have loan repayment. Now, loan repayment is capital in nature because it's the principal payment of the loan. What you need to pay is the interest, not the principal. So leave out loan repayment. Then the tractor is the capital expenditure. We claim investment allowances. Derivative oil losses we can charge. They must have entered into some forward contracts, which we call hedging, and they made losses. So derivatives, oil losses. So derivatives, oil losses is 480. So we shall charge 480 here for derivatives, oil losses. Restructuring expenses, there's a note. Note 2, restructuring expenses include 582, paid to a consultancy firm that restructured the capital structure of the company. So the capital structure is taken to be capital in nature. So under restructuring expenses, we adjust. So we take 848, we remove the 582. So we remove the 582, and we're left with 266. So restructuring expenses. $848. We adjust for 582, and we are left with 266. That's restructuring. Then forklift will also be capital allowances. Then we claim investment allowances. So let's claim investment allowances. First, there are assets that were given in note 3, like plant and machinery. Plant and machinery. So for plant and machinery, we claim 50%. So this is 4.8. We take 50% of that, 2,400,000 for plant and machinery. Then we have direction of rigs and tankage. We also have rigs and tankage assembly. So rigs and tankage is 1.6. Again, we take 50%. Rigs and tankage is 800. Then you have pipes and storage tanks. So pipes and storage is 9480. We get 50% of 9480. It should be 4740. Then you have the factory building itself. Factory is 48,400. You get 50%. That's 24,200. That is factory. Then you get the other assets. like we have drilling machines, it's 18,300. So we have drilling machines. $18,300. This one you get 10%. Simply other machinery is 18,30 for drilling machines. Then you have a tractor is 1,500. You get 25% for a tractor. 1,500. You get 25%. 75 for a tractor. Then we have a forklift is 1,800. So it's a forklift is 1,800. You get 25%. It's 450. So that should give you the taxable income of rigs drilling. So we look at one last question. We look at November 2020. November 2020, question 2. So we look at November 2020, question 2. So November 2020, question 2. The following financial information was extracted from the books of oil drillers and explorers limited for the year ending. So this is November 2020. November 2020 will be November 2020. November 2020, question 2A. The following financial information was extracted from the books of oil drillers and exporters limited for the year ended 31st December 2019. So income their proceeds of oil sold to foreign subsidiary company. They sold 50,000 barrels of crude oil at 500 each, and the income was 25 million. Value of oil disposed of to local refineries, freight charges received from other oil companies for transporting their crude oil to the neighboring country, sale of natural gas, expenditure of staff accommodation expenses, wages and salaries for employees, annual compensation paid to local people for disturbance during petroleum exploration, royalties incurred in respect of crude oil exported, interest on loan from a foreign subsidiary company, specific budgets written off, depreciation of non-current assets, exploration and drilling costs in respect of cement and casing of oil wells, contribution to approved provident fund, customs duty and imported equipment, general expenses, additional information. Non-current assets comprise drilling machine, furniture and saloon car acquired during the year. Staff accommodation expenses include management fees of 18,000 for a director for a foreign subsidiary company. Lorries for transporting crude oil comprise of 7.5 tons lorry, 2,400,000, 4.2 tons lorry, that should be 1,800,000. Required a statement of taxable profit or loss for the year ended. So prepare a statement of taxable profit or loss for the current year. So the company is called Oil Driller. Oil Driller and Exporters. So from the items given, we need to find out what are the incomes and what are the allowable expenses from the list. So first look for incomes. Then we get allowable expenses. For example, we have for proceeds from oil sold to a foreign subsidiary of 25 million. So proceeds we should remember under our discussion on the limited company, said a subsidiary is a separate entity. Had this been a branch, I would not have shown that income as an income because a branch and the parent are one and the same thing, so it cannot be separate. We say the subsidiary is registered in its own name, so it becomes as soon as it's incorporated, it's a separate legal entity. So it means any sales to the subsidiary is independent. You can recognize that as an income, but had it been a branch, it could have been something different. It's like you're selling within the same group. So a branch is simply an outlet. So this one is a sales. So recognize 25 million as a sale. This one is a sale. Then value of oil disposed to local refineries. So that's 125,000. This is just 125. Then you have freight charges received from other oil companies. Freight charges. So freight charges received from other companies for transport is 190. Then you have sale of natural gas. Is it 160? What does your paper say? 160. Mine is getting erased a bit. 60. So the rest are expenses. So this is our income items. Then you have staff accommodation expenses and to staff accommodation expenses include management fees of 18 for directors from foreign subsidiary companies. So we shall exclude that from staff accommodation. The staff accommodation expenses is 60 less the 18. Wages and salaries for employees. Your figure is 45, eh? Is it 45?
Yes, 15.
Or 15? Wages and salaries for employees, okay? So wages and salaries for employees. Annual compensation paid to local people for disturbance. So compensation. So compensation to local people, 75. 75,000? Okay. Royalties incurred in respect of crude oil exported. Royalties incurred for exports is 42. Interest on loan from a subsidiary company. Now that will not be allowable. It's a subsidiary, not a branch. Interest on loan from a subsidiary company will be allowed. So that's at arm's length. Interest and loan from a subsidiary. Specific bad debts written off. Depreciation of non-current assets is not allowed. Exploration and drilling costs in respect to cement and casing of oil wells. Now that's an example of intangible drilling costs. They are allowed. So that's exploration. And drilling. In respect of cementing and casing of oil wells is allowable. So 24,500. Contribution to approved pension scheme is allowable. Contribution to approved. Approved pension fund. Yes.
Exploration should be 4,500, 4,500,000.
Which one?
Exploration. Exploration and drilling.
It's 24,500. Yours is 4,000.
4,500,000.
There's a 2 missing. Should be 24,500,000. The full figure is 24,500,000. It's 24,500,000. Customs duty on imported equipment is not allowable. That is a tax. Then you have general expenses of 65. Then you can also claim investment allowances. Non-current assets comprise drilling machinery, furniture, so you also claim investment allowances. We have drilling machines. $900. We take 10% for other machinery. which is 240. Saloon car, 2.8, take 25%. Then kuna lori, $7.5 tons. Though the tons doesn't really matter. 2,400,000. Yes?
6,705.
So this is 26, 707, 7.5. That gives us a loss. So that is treatment of extractive industries. So I want to introduce another topic. want to introduce a topic called air transport, sea and air transport undertakings. So those who are engaged in businesses of hiring out, not really hire, but those who own planes and ships for transport of passenger and goods. So this topic is called sea and air transport. Sea and air transport undertakings. Sea and air transport undertakings. Sea and air transport undertakings. To begin with, by looking at air transportation business. Air transportation business. You see, air transportation involves air transportation involves the transportation by air. Air transportation involves the transportation by air of A, passengers, B, cargo and handling, C, mail and handling services. Mail, M-A-I-L, mail and handling services. The new paragraph is section 9. Section 9, subsection 1 of the ITA, Income Tax Act. Section 9 in brackets 1 of the ITA states that Section 9, subsection 1 of the ITA states that, open quote, where a non-resident person carries on the business. Where a non-resident person carries on the business of a charterer, or air transport operator, where an unresident person carries on the business of a charterer or air transport operator, and an aircraft owned or chartered by him, calls at any airport, in Kenya, the gains or profits from that business. The gains or profits from that business. The gains or profits from that business, from the carriage of passengers, from the carriage of passengers, the gains or profits from that business, from the carriage of passengers, from the carriage of passengers who embark, who embark, who embark, or cargo or mail, or cargo or mail which is embarked in Kenya, or cargo or mail which is embarked in Kenya, or cargo or mail which is embarked in Kenya, shall be the gross amount received, shall be the gross amount received, shall be the gross amount received on account of the carriage, shall be the gross amount received on account of the carriage, shall be the gross amount received on account of the carriage, on account of the carriage, and those gains or profits, and those gains or profits shall be deemed to be income. And those gains or profits shall be deemed to be income, and those gains or profits shall be deemed to be income derived from Kenya. And those gains or profits shall be deemed to be income derived from Kenya. New paragraph. The gains or profits, the gains or profits chargeable to tax in Kenya, the gains or profits chargeable to tax in Kenya, the gains or profits chargeable to tax in Kenya shall not include any gains, shall not include any gains from, shall not include any gains from A, shall not include any gains from A, passengers who embark, passengers who embark, passengers who embark, B, cargo or mail which is embarked, cargo or mail which is embarked on transshipment, cargo or mail which is embarked on transshipment, cargo or mail which is embarked on transshipment, on transshipment, cargo or mail which is embarked on transshipment. New paragraph, you see the term transshipment, you can put it in quotes. The term transshipment means the movement of goods. The term transshipment means the movement of goods from an aircraft. The term transshipment means the movement of goods from an aircraft. The term transshipment means the movement of goods from an aircraft, vessel, or vehicle. The movement of goods from an aircraft, vessel, or vehicle, arriving in Kenya, arriving in Kenya, arriving in Kenya from a foreign country, arriving in Kenya from a foreign country, arriving in Kenya from a foreign country to an aircraft, to an aircraft, vessel, or vehicle, to an aircraft, vessel, or vehicle, to an aircraft, vessel, or vehicle, departing to a foreign country, departing to a foreign country, the new paragraph, the income of a non-resident person, the income of a non-resident person, the income of a non-resident person who carries on the business of aircraft owner, the income of a non-resident person who carries on the business of an aircraft owner, charterer, or air transport operator, shall be granted exemptions from such a business, where the country in which the non-resident person is a resident, also extends a similar exemption, to aircraft owners, charterers, or air transport operators, who are resident in Kenya. Who are resident in Kenya. So that is air transport. We want to get an illustration in this. So our illustration, our first illustration will be called Metro 9 Air Safaris. Network GX. GX is May 2018. May 2018 question 4. May 2018 question 4 is called GX Air Safaris. May 2018 question 4 is called GX Air Safaris. The question reads, GX Air Safaris Limited is a foreign company operating a fleet of passenger and cargo aircrafts in East Africa, so in the Far East. Is it Kenya? Again, is a bit erased here. So GX Air Safaris Limited is a foreign company operating a fleet of passenger and cargo aircrafts in Kenya and Middle East and Far East. The operating results for the year ended 30th September as follows. Income from cargo freight Kenya to China. Income from passengers and freight Kenya to the Middle East. Income from passengers and freight South Korea to Kenya. Income from cargo loaded into aircraft on all routes. Salaries and other expenses, accumulated depreciation on aircraft. General provision for bad debts. Additional information. Salaries and other expenses include purchase of plane engines, use of airport facilities, hotel bills for first-class passengers, accommodation for airline crew, gifts to airport staff. The airline has a fleet of 4 aircrafts whose total cost before accumulated depreciation was 360 million. Required a statement of total taxable profit of GX Air Safaris for the year ended, and tax liability, if any, for the airline for the year. Then I think we'll also answer B. B says the revenue authority in your country recently established a medium taxpayers office, MTO, as part of tax reforms required. Discuss 5 objectives of medium taxpayers office. So first, we look at this. So from our discussion under section 9, subsection 1, you can only recognize income that accrued from transportation of passengers or cargo that were embarked from Kenya. So it means any other income embarked from elsewhere does not belong to tax here. For example, the first item there says income from cargo freight. Now the embarkment was from Kenya. So the plane left Kenya to China. Then obviously that's taxable income that accrued here. So the first one is income from cargo. So income from cargo, cargo freight, the transported cargo. So from cargo freight, this cargo freight is coming from Kenya, going to China. So it's income accruing from Kenya, so that's 1567. Then we have income for passengers and freight. Again, it's embarked from Kenya to the Middle East. So we have income passengers and freight. Then you have income from cargo loaded into aircraft on all routes. So we cannot recognize that as taxable income, because this is an international airline. So it's an international company operating aircraft in Kenya, Middle East, and even Far East. So you cannot claim tax on all routes, because that's a different item altogether. So before that, before cargo, there's one. So income from cargo and freight, South Korea to Kenya, even that we can't claim because of the embarkment. Where did the cargo first embark? In South Korea. So that income cannot be taxed in Kenya. Same to income from cargo loaded into all routes. This is an international airline. So apparently we don't have any other income. So this will be the only income. Then that's an allowed expenses. So there's something called salaries and other expenses, but salaries and other expenses has a list. There's a breakdown in note 1. So want to break down that. So want to first remove the items in note 1 so that we analyze note 1 second. So salaries and other expenses. So we take the whole amount, 1548, but we'll subtract the total items in note 1 so that we deal with note 1 separately. So we deduct 207,000. Yeah? So 1341,000 is salaries and wages. Accumulated depreciation on aircraft is not allowable. General provision for bad debts is not allowed. In the note 1, the breakdown, there's purchase of plane engines, now that's capital expenditure. Use of airport facilities is allowable, so earlier use of airport facilities. So use of airport facilities is 32. Hotel bills for first class passengers. Accommodation for airline crew. Gifts for airport staff will not be allowed. These are just gifts. Then the airline had a fleet of 4 aircraft whose total cost before accumulated depreciation was 360 million. So get investment allowance. On aircraft. So aircraft is supposed to be 50% in the first year and 25% on reducing balance. This is not the first year. We know that because of the accumulated depreciation. So you take accumulated depreciation of 360 million minus accumulated depreciation so that you get the current residual value, then you get 25% of that. So 25, it's 50% in the first year and 25% in each of the subsequent years on the residual value. So we get the residual value, so minus 88, so 272, then we get 25%. So 68,000. So that should give the profit or loss. The income. Income is 1844.
No.
Mm.
3,332,720.
Then expenses.
1488.
1888. So that income is
1844.
1844. 520. Then tax liability. So the rate will be 37.5%. That's the rate for a non-resident company. So how much?
691,
6?
691, 695.
695. Like that. 1,000.
Yeah.
So there was a part B. So it has been years now, but this segmentation of taxpayers, they started with large taxpayers unit before they got very good results, and they decided to bring in middle taxpayers office, and they continued with segmentation because it allows more focus, maybe on a particular group of taxpayers, and results in excellent results in terms of compliance and revenue collection. So we're being asked here, the Revenue Authority in your country recently established a medium taxpayers office as part of the tax reforms. Discuss 5 objectives of MTO. So please, objectives of medium taxpayers office. 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 The first objective, to enhance high voluntary tax compliance. 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 Next, to ensure better service delivery. To ensure better service delivery. To ensure better service delivery through taxpayer segmentation. To ensure better service delivery through taxpayer segmentation. Through taxpayer segmentation based on the taxpayers industry. To ensure better service delivery through taxpayer segmentation based on the taxpayers industry. Next, to entrench relationship management. To entrench relationship management. To entrench relationship management that caters for taxpayers' needs. To entrench relationship management that caters for taxpayers' needs. That takes to entrench relationship management that caters for taxpayers' needs on a personal basis. On a personal basis, taxpayers' needs on a personal basis. Next, to ensure professionalism. To ensure professionalism and integrity. To ensure professionalism and integrity in tax administration. To ensure professionalism and integrity in tax administration. Next, to carry out quality. To carry out quality and forecast. Carry out quality and forecast audits. Carry out quality and forecast audits based on an objective risk profiling. Based on an objective risk profiling. Based on an objective risk profiling framework. Based on an objective risk profiling framework. Lastly, to foster a close working relationship. To foster a close working relationship. To foster a close working relationship with taxpayers. To foster a close working relationship with taxpayers.